Scan now. Meet Sovi, your new AI study buddy. Shrimp and chicken are substitute inputs in frozen meals, so let's see how a tax on shrimp changes the market for chicken in meals. First, the government imposes a per-unit tax on shrimp, which raises the cost of using shrimp for producers. This tax effectively reduces the supply and increases the price of shrimp. Since shrimp and chicken are substitute inputs, producers will switch away from expensive shrimp and buy more chicken instead. This shift causes the overall demand for chicken to increase immediately. Finally, higher input costs for both shrimp and chicken shift the meal supply curve left, which forces the equilibrium price of frozen meals to increase. Well done! Scan the code. You can learn better with Sovi. Avoid a rush to judgment. Trust the given relationships and check your steps.